Hello and welcome to Swissquote's Daily Market Talk. Today is NFP Friday, September 6th, and market sentiment is quite cautious right now following yesterday's soft ADP report from the US. Now, many investors believe that today's jobs figures from the US could be pivotal in determining whether the Federal Reserve will cut its interest rates by 25 or by 50 basis points at its meeting later this month. So, brace yourselves for potential volatility before this week's closing bell. So risk appetite got another hit yesterday after the US ADP report printed a weaker than expected number. So the data suggested that the US economy added only 99,000 new private jobs last month. That's significantly less than 144,000 penciled in by analysts and lower than last month's figure as well, even after the downside revision of last month's figure to 111,000 jobs. And job cuts nearly tripled in August as well. Now, many good news is that, while the labor productivity in the US increased and the unit cost decreased significantly in the second quarter. So, all in all of the latter numbers that we saw support the idea that it is gently time for the Fed to start cutting its interest rates. The question is, by how much? So it will depend on today's economic data, today's jobs data, according to many. In the aftermath of soft job openings and ADP reports from the US, the pricing of a 100 basis point cut from September to the end of this year remains unchanged, but the probability of a 50 basis point cut in September is gaining traction this week. So that probability now stands near 43%, up from about a third at the start of this week. So the US yields continue to dive. The US 2-year yield eased to 3.71% level yesterday. The US 10-year yield fell to about the same level, and the US dollar index gave back about 2/3 of its latest rebound. Now, the rising Federal Reserve interest rate cut expectations and the falling yields in the US failed to cheer up the stock investors yesterday. The S&P 500 fell and closed near its 50-day moving average. Nasdaq 100 eked out a small gain but remained below its own 100-day moving average at yesterday's close, while the Dow Jones Industrial Index and the Russell 2000 Index underperformed the other peers. Crude oil jumped above the $70 per barrel level on news that OPEC Plus will not relax restrictions for 2 more months, but couldn't hold ground at this level and is heading into the much anticipated and the much important US jobs figures below this psychological $70 per barrel mark. Now, this is where we are in terms of market pricing before the critical US jobs data, which is believed to be tilting the balance between a 25 or a 50 basis point cut for the Federal Reserve's September monetary policy meeting. So it's a big responsibility and a lot of weight on just one set of figures. So we will likely get served a nice and good volatility before this week ends, in the sense the VIX index is already showing signs of stress in the market. Now, let's talk about why this data is so much important, right? Well, yes, it is above all because the Federal Reserve Chair Jerome Powell said that a further weakness in the jobs market in the US is undesired. So that's obviously a good reason for investors around the world to put a lot of weight on all this jobs data. But from a theoretical perspective, there are actually two things that make this month's US jobs data quite more important than the previous ones. First is this famous SAMS rule that you probably heard before, which suggests that the economy is already in a recession when the 3-month moving average of the unemployment rate rises by 0.50 percentage points or more above its low point over the previous 12 months. This is the rule, and this rule was triggered back in July, and the whole thing suggests that the US economy may be already in a recession, maybe since 2 to 3 months already. Because the only time the SAMS rule wasn't right was on November 1959, a long time ago, but a recession arrived 5 months later anyway, even after that month. And well, the second reason is from a theoretical perspective. A research paper published by the Federal Reserve's very own Christoph Waller that argues that once the job vacancy rate falls to the pre-pandemic level of 4.6%, then the unemployment rate would rise to 4.5%. And that line was crossed on Wednesday this week when the US jobs report actually showed the vacancy rate in the US declining to 4.56% in July. So, if we rely on the theory, the US jobs market and the US economy may be in trouble. And this is pretty much why everyone is suddenly super focused on the jobs data again and partly minimizing the inflation side of this whole story on assumption that things there or under control right now and will probably remain so with the deterioration that we see in the jobs space. Now, of course, this theory is quite disquieting, yet wait before you get too excited or too stressed about things. Because first of all, the dynamics and the drivers of the jobs market in the US have been quite different since, the pandemic times. And also there's the fact that immigration is also believed to be changing the cause and effect relationships in the market today compared to the past where we have the data from. Then the economic theory is based on a bunch of economic data and statistics, so it is not an exact science. So it is very well possible that we don't see the same data leading to the same end result each time around. And in this context, many have been just calling a US recession, remember, since the 2 to 10 year portion of the US yield curve inverse. But that was more than 2 years ago, and yet, the letter has not shown up in the data just yet. Now, I know that the Main Street feels like the US is already in a recession, but again, it is yet to be shown in the US official data because looking at the growth data, the growth data printed a 3% growth in last quarter's GDP in the US. Now, it's sure that there is some evidence of slowing growth in this quarter, but note that the market swings between two extremes, so between optimism of soft landing and pessimism of a potentially ugly recession quite fast, especially after important data. And in numbers, the US economy is expected to have added around 164,000 new non-farm jobs last month. That is obviously not a great number, but that would be better than the 114,000 job additions printed a month earlier. The unemployment rate in the US, on the other hand, is expected to have improved from 4.3 to 4.2%, and the wages in the US may have grown slightly faster. So as you see, the expectations are not that bad after all. Now, the ADP report that was printed yesterday hints that we could actually see a soft NFP read today as well because the correlation between the two numbers has been rising recently, but the 30-month rolling correlation between ADP and NFP reads is still very low. It's about 20 to 30%. So to me, there is still a chance that the August data beats the soft market expectations, in which case we could see the US yields and the US dollar rebound and equities and oil close the week on a positive note. But another month of disappointment in the US jobs data will likely boost the pricing of a 50 basis point cut in September from the Fed, further weigh on the US yields, on the US dollar, and probably on equities and oil as well. So fingers are crossed. Now, this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.